All right. So glad to see everybody. I just want to remind you, if you are tuning into this on YouTube, please hit the like, subscribe, and notification bell so that you're notified of these webinars. Now, you can't, unless you subscribe, you can't comment. And we've got a comment, or a chat bar that runs that I can see. For instance, my wife is on and she told me it sounds and looks good. That's very helpful. But if you're not subscribed, you can't ask me a question live during the webinar. So go ahead and subscribe so that you can do that. And I think that would be helpful to you. All right. So we've got a lot of things coming up. We just wrapped up a class. Well, we're actually ending tonight at Holy Family University. So tonight is the last of the two series classes. It starts at 6:30, ends at 9:30. It's a lot of great information. It's the Changing World of Retirement class. It's written by our friend David McKnight. So many of you know David, and many of you know Ed Slott because you've heard me talk about them or have heard me talk to them on these webinars. And both Ed and Dave will be joining us on May 16th at 6:30 p.m. at the Newtown Theater in, you guessed it, Newtown. And that's going to be a lot of fun. So two thought leaders in the industry as far as how to effectively get you your money out of your retirement accounts without having too much pain or too much tax rate risk. And that leads to potentially more and higher withdrawals for either you or your heirs and less sent to the federal government. And Ed and Dave, I would argue that they are the first of all, the number one and number two, however you want to slice it. As I said, thought leaders in the industry, and they're both going to be here live for you. We're going to give out some of Dave's books. We're going to give out some of Ed's books. They're both going to do a book signing. It's going to be a full night. We're going to have great food. It's a great venue. So I hope you can all join us. All right. So, we're going to talk a little bit about the headlines, and then we're going to jump into the slot questions. But I just wanted to remind you, we're going to talk about FDIC limits a little bit today in the slot update. But I wanted to remind you to check in with your bank. I know there's a lot of conversation about banks, local banks, small banks, larger banks. Remind yourself of these FDIC thresholds, and everyone's talking about risks that are associated with banks. And let's face it, all banks have risk. It's just how they manage it and how committed the federal government is going to be in backstopping that risk. And by backstopping is, are they going to step in and make sure that your deposits are secure? So it seems to be that that's going to be the case, but the process hasn't been laid out clearly yet. They've said we're going to make sure that your backstop, you're protected, but yet to be seen exactly what that looks like. There was some discussion, but the Treasury Secretary Janet Yellen, some people didn't like what she said about the protections in the market, or the protections in the banks, and she had to go back and kind of correct herself. But so pay attention to your FDIC thresholds, the institution that you're holding your funds in, and maybe you decide to keep more than the $250,000 FDIC limit in your banks, but you've got to be aware of that risk. Okay, so I'm going to share my screen here in a moment, and we're going to actually talk about FDIC limits from Sarah Brenner. So you should see our friend Sarah Brenner, who unfortunately received an email from me at about 5 o'clock this morning with a question concerning a client or actually a class attendee and a IRA distribution or 401k distribution. So Sarah writes, 5 facts you need to know about FDIC insurance and your IRA. So folks hold their IRA funds sometimes in banks too. Well, are your IRA funds protected if the bank goes under? So let's review that. The Federal Deposit Insurance Corporation has been in the news recently as bank failures have made headlines. The FDIC is an independent agency created by Congress. It provides deposit insurance coverage for institutions such as banks in the event that the bank fails and does not have enough assets to pay off depositors. The FDIC insures deposits up to $250,000. You may wonder if your IRA, and I'm scrolling down here, is protected by the FDIC. Here are 5 facts you need to know. Number 1, not all IRAs are protected by FDIC insurance. The FDIC only protects deposit accounts at FDIC insured institutions. If your IRA is invested in deposits such as a checking account, a savings account, or a certificate of deposit, CD, it would be protected. However, if your IRA is invested in stocks, mutual funds, or annuity products, it would not be protected by FDIC insurance. This is true even if your IRA is held by an FDIC insured institution. So what is an FDIC insured institution that may also have these investments? Well, just about everybody, it seems, who's in banking. Think about Merrill Lynch, owned by Bank of America, Wells Fargo, owned by Wells Fargo, right? So the Wells Fargo advisors are owned by Wells Fargo Bank. PNC. So that's not endorsing these banks or saying that there's an issue with them or their investment divisions within them, but almost every bank has investment divisions within their banks, even if it's a trust company. But there are not those investments, mutual funds, annuities, stocks, bonds, exchange traded funds, you name it. If it's not a bank product, a deposit product, such as a CD, savings account, checking account, money market account, it is not covered by FDIC insurance. So be aware of that. Even, listen, when I worked at Wachovia, which became Wells Fargo, people used to come into the bank branch to see me. So it can be confusing, right? So you think, well, my CDs are over there, my investments are over here. It's a different office, but it's the same building. So you got to know the different coverage levels. Number 2, IRA deposits are insured separately at each institution. If you have multiple IRAs at different banks, each of your IRAs is insured separately up to the $250,000 limit. So this confuses people sometimes. Actually, I'm going to switch this screen so you can see me in the corner. Yeah, people say they like that better. That's the reason I did that. So if you have multiple IRAs at different banks, each of your IRAs is insured separately up to the $250,000 limit. Number 3, your IRAs are insured separately from other deposits. If you have both IRA assets and other assets at the same bank, your IRA deposits are insured separately from other deposits you might have at the same institution. For example, if you have a $200,000 IRA and a $200,000 in non-IRA CDs at the same bank, all of your deposits are fully protected up to the $250,000 limit. So that's something that a lot of people don't know. They think $250,000, that's it. But if you have it in IRA and non-IRA, it is covered differently. Number 4, inherited IRA assets are also insured separately, even if at the same bank. For example, if you inherit an IRA worth $250,000 from your mother, which is invested in a CD, and you also have $50,000 in IRA deposits in a different CD at the same bank, both your inherited IRA and your own IRA funds are fully protected by FDIC insurance, again, up to the $250,000 levels, each of them. What about traditional and Roth deposits, though? Traditional and Roth IRA deposits are not insured separately. For purposes of the $250,000 limit for IRAs, any traditional and Roth IRA deposits at the same institution are aggregated. They're counted together. If you have $150,000 deposited in a Roth IRA and $200,000 deposited in a traditional IRA at the same bank, only $250,000 of your $350,000 total IRA deposits at that bank is protected by FDIC insurance. So you can see, like most things, this is very confusing too. So it's important to kind of know the rules, or definitely know the rules. Unfortunately, sometimes even the bankers don't know the rules. I was talking to a client who had this concern, went into his bank, and the bank said, well, no, if you've got, if you do A, B, or C, then you've got different, you get different coverage amounts, and that's not accurate. So you've got to know the rules here, if that's a concern of yours. And by the way, it should be, right? You should not that you should, again, I'm just going to say, not that you should be concerned that we're going to have a massive run on the banks. I don't think that's the case. We might see some other smaller banks fail. But you should know your amounts at risk and act accordingly. You shouldn't be surprised by any of this. It's well publicized. clearly discussed. And although the rules can be confusing, so if you need help, reach out. Employer plans and the 5-year rule. This is the Slott Report mailbag. So this is questions that come into the analyst and Ed and his team, and with specific questions. And I like to share these with you because it keeps us constantly engaged. Now that's really important. I told people at the class that ended on Thursday, and I'll say it again tonight if I remember, and hopefully I will, that it's so important. People come to a class, or they listen to one of our special webinars, or they might attend the event that we're having with Ed and Dave in May, and they get very motivated. Okay, well this is great information, and I'm going to make changes to my financial plan and maybe even to my investments, and I'm going to start. I'm going to pay attention to tax efficiency. I'm going to pay attention to long-term care risk, and I'm going to pay attention to the different type of market risks, and then that can fizzle out, right? You have this motivation, you have this momentum, and then you can fizzle out. Well, we don't want that to happen. And one of the reasons that I get up at 5 o'clock in the morning on Tuesdays, and these webinars take about certainly 3 days to prepare for. I do a little bit of work Sunday night. I do a little bit of work on Monday, sometimes a lot more work on Monday, and a lot of work on Tuesday mornings. And I enjoy doing it. So don't feel bad for me, but I do it because it's so important to constantly have this education and these reminders. So if you only took that half an hour, or even the 15 minutes, the 45-minute full weekly webinar, or even the 15 minutes, then you're better off than somebody who attended a webinar or a class and never did anything, or even never even bothered to attend something. So that is you always want to have this education going, just to learn more, to be reminded, and to keep your momentum up. So I hope that makes sense. So here's the question, or one of the questions today. The question is, my daughter had 2 employers during 2022. The first employer offered a matching 401k plan in which she enrolled. The second employer, her current employer, offers no retirement plan benefit. In preparing my daughter's 2022 federal tax return on TurboTax, she is unable to take advantage of a deduction for an IRA contribution because the 2022 W-2 from her first employer in 2022 indicates that she is covered by a retirement plan. The 2022 W-2 from her current employer does not. Is there any way my daughter can make an IRA deduction on her 2022 tax return? Thank you for taking my inquiry. Okay, so there's a lot of 22s and W-2s in there. So Tom's daughter worked for 2 different companies. One had a 401k. One did not have a retirement plan at all in 2022. So TurboTax is saying she cannot make a contribution, or a deductible contribution, in 2022 because she was covered under a retirement plan. Now, let me just pause there for a second and say, Tom, get some professional help. I know a lot of folks like to use TurboTax and whatnot. I've never seen a situation where paying a professional hasn't been a benefit. I've seen many. Now, I don't do tax preparation, right? So this is not, I don't have a horse in this race. We don't receive compensation for tax preparation at all. Tax planning, of course we do that. But many people like to do these things on their own. And TurboTax, of course, does make TurboTax, or whatever else is out there these days, does make things easier, but it also makes them easier to miss things or make mistakes. So, I've seen many examples where people have overspent tremendous amounts of money, in my opinion, for tax they didn't need to pay because they wouldn't pay a professional to help them, or they've missed opportunities because they wouldn't pay a professional to help them. So listen, find the right person. Should be part of your team. Remember, I believe a certified financial planner, a CPA, and at least a state attorney. So what's the answer here? Sarah writes, I'll let that settle for a minute. If an individual participates in an employer plan like a 401k, even for a very short period of time during the year, they are considered an active participant in a retirement plan for the whole year. This means that if their income is above certain levels, they are not allowed to deduct their traditional IRA contribution. For 2022, for single filers, the ability to deduct a traditional IRA contribution phases out when modified adjusted gross income is between $68,000 and $78,000. For those who are married filing jointly, it phases out between $109,000 and $129,000. Since TurboTax said she could not take a deduction, I am assuming she's over one of these levels. If your daughter and her spouse, if married, did not participate in a plan for 2023, she will be able to deduct her IRA contribution. There are no income limits for those who do not participate in a plan at all during the year. Really, really great question. Well answered by Sarah, as always. And just another example of why you should hire a professional. So the next question, I am 62 years old and retire. If I initiate a Roth IRA conversion for my employer's 401k retirement savings plan in 2023 and make an additional Roth IRA conversion every year for the next 10 years, is the 5-year rule for tax-free withdrawals satisfied beginning in 2028 for all withdrawals? Or does each Roth IRA conversion have its own 5-year rule? Thank you. So the key here is 62 years old. I don't know if I can write on this. I'm going to see. Yes, 62 years old. 5-year rule can be very confusing if you're under 59 and a half, but I always remind people, if you're over 59 and a half, it gets much simpler. As long as you've had a Roth IRA in place for 5 years, then that 5-year rule doesn't apply. And we've talked about the 5-year rule. If you have questions specifically about the 5-year rule, you can write into us at questions@attleeborowealth.com. That's questions@attleeborowealth.com. So Sarah answers, the 5-year holding period for tax-free distributions of earnings from a Roth IRA begins with the first Roth contribution or conversion. It does not restart with the subsequent contributions or conversions. Since you are over 59 and a half and will have owned a Roth IRA for 5 years or more by 2028, any distribution of earnings taken in 2028 or later would be tax-free. The key, again, is over 59 and a half here. If you're under 59 and a half, it's much more complicated. You do have to track your conversions and contributions separately. So again, if you have questions about that, please reach out. All right, I'm going to stop my share here. And we're going to jump to the rest of our discussion about the markets. Now we're heading into the markets. So let's talk about what the Dow Jones Industrial Average did last week. I'm just adjusting my screen so I can see it a little bit better. The Dow Jones Industrial Average was up 1.18%. It's still down 2.2% for the year, 5% year over year. The S&P 500 was up 1.41%. That's positive for the year, 3.85%. The NASDAQ was up 1.61%, positive 13.23%. 13.23% for the year. The global indices were up 1.51, 2.23, and they're all positive also for the year. The bond market is positive for the year. Thank you. The aggregate bond index was up 0.5% last week. It's up 3.44 for the year. Still down about 5%. Well, I shouldn't say that. Just over 4%, 4.09. It's down still year over year. Bond market really got hammered last year, and to lots of people's surprise, and you hear me talk about that every week. Interest rates went up again, so the Fed went from target rate of 4.75 to 5% last week. So that's another 0.25%. Everybody was expecting 0.5, but they eased back. They said it wasn't because of the banks, but for whatever reason, they eased back to 0.25. So here we are at 5. The 6-month U.S. Treasury is at 4.69, slightly higher than it was the week before at 4.60, but not quite as high as it was at year end at 4.75. So we are seeing the shorter term drop down. And here's a good example. A 2-year Treasury is now at 3.77. At the end of the year in 2022 is at 4.43. So we are starting to see the shorter end of that curve come down. That does not mean, in my opinion, that we're going to avoid a recession, though. Okay. Our new strategic partners as of the beginning of the year, Cornerstone Portfolio Research. They give us a market report every week, and I really like it. And they talked about existing home sales. So sales rose a surprising 14.5% in February, above expectations, and the largest monthly percentage increase since July of 2020. I think that's interesting. The median price of those homes, however, declined 0.2% year over year. The first year-over-year decline in 11 years. So that's significant. So lower mortgage rates help boost the housing market, indicating that home buyers are still out there, but are more cost conscious than they may have been over the past couple of years. Right? Makes sense. As I said, the Federal Reserve raised interest rates by 0.25% as expected to 5%, while addressing the banking crisis in the statement by noting the system is sound and resilient. One key phrase change was the replacement of further rate hikes may be necessary to additional policy firming may be appropriate. So everybody listens very closely to what the chairman of the Federal Reserve says when he's testifying before Congress. And they're focusing on this. Well, in this report, they're focusing on this change of phrase from further rate hikes may be necessary to additional policy firming may be appropriate. So some people are taking that to think that maybe the Fed might be softening a bit. Some people are, the bond market's counting on, they seem to be counting on cuts at the end of the year, the way the bond market is acting. So we'll see. So Cornerstone wrote, the chairman made clear that the Fed views the banking crisis and monetary policy as two different buckets with different tools available to address each one. However, as a change in phrases indicates, the banking crisis and possible reduction in credit availability could take the place of a rate hike or two. So credit is going to be probably much more difficult to attain, or just costly, right? So there are projects that are probably not going to be funded or started all around the country. The Wall Street Journal. I'll share with you what the Wall Street Journal talked about this morning, and they wrote an article. Wall Street is warming up to banks, and I'll just read it to you. So the growing number of investors are betting on a growing number of investors are betting on a rebound in the banking sector, wagering that regional lenders are in much better condition than many initially feared after the collapse of Silicon National Bank. The situation in the banking sector is fluid and investors broadly remain on edge, but many challenge the notion that there is any fundamental widespread problem on the asset side of bank balance sheets. Everybody's kind of checking the balance sheets, and Silicon Valley seemed to be an outlier because they just didn't seem to handle their debt obligations well. So, it is, again, you should know your FDIC limits, know what's at risk in your bank, but the risk might be very, very small that something's going to derail going forward. There, with good solid banks, we may see some other small banks, as I said, fail or get bought out. But for the most part, I think we're okay. So I say that carefully. You've got to be careful where you have your funds. So on Monday, First Citizens share price rose 54% after it reached a deal to buy large parts of SVB, that's Silicon National Bank, and shares of U.S. regional banks also rallied. First Republic Bank increased 12%, Pacific West Bancorp 3.5%, and Western Alliance Bancorp 3%. So it goes on to talk about some other bank increases. So BlackRock wrote, the central bank trade-off between crushing activity or living with inflation is now impossible to ignore as economic damage and financial cracks emerge. That was evident in the Federal Reserve's forecast of recession this year and sticky inflation in years to come. Central banks have clearly separated responses to the banking situation and kept hiking rates. We see a new, more nuanced phase of curbing inflation ahead. Less fighting, but still no rate cuts. We favor inflation-linked bonds, they said. That's BlackRock. So, as I said, Many bond analysts are saying that the bond market is pricing in rate cuts at the end of the year. BlackRock's saying they're not seeing any rate cuts. So I do like to show different thoughts out there, and then you can make your decisions accordingly. And how do you handle this? Of course, you should have a strong financial plan that you review every year. You should have your good asset allocation strategy in place. You should have a principal protection strategy in place, and of course your account segmentation strategy in place, so that from an investment point of view and from a financial planning point of view, again, have that plan up to date and a good comprehensive plan. And along with the principal protection, a lot of the principal protected platforms also carry some sort of lifetime income. And from a planning perspective, that can really help give you some stability in your plan. So that's how you overcome all of this crazy discussion out there about, who's going to be right. Are the Fed's going to cut, or at the end of the year, are they not going to cut? BlackRock says one thing, somebody else says another, and you can just get different opinions all over the place. It's a little scarier when you're not getting different opinions. All right, let's move on now to our financial planning topic. And that is RMD rules you need to know. So you're going to see me, of course, looking down as I draw on this screen. And if you're just joining us from the Financial 15 on YouTube or via any recording, I guess, this is the section where we talk about the financial planning strategy. Of course, today is RMD rules you need to know. But if you wanted to watch the whole webinar, the entire 45 minutes or so, then seek out the Tuesday weekly webinar with the same topic, RMD rules you need to know. And you can hear the slot updates where we talk about the distribution issues that you need to be aware of when you're taking withdrawals out of your IRA accounts. So we do a different topic. It's just different information that comes in every week. And then we do a market recap and some analyst updates. So join us for the weekly webinar as well. And for those of you who've been with me since 10 o'clock, I apologize for the commercial, but we want to make sure that people are getting the full content if they want it. So today, again, RMD rules you need to know. So first, what is an RMD? So an RMD is a required minimum distribution from your distribution from your retirement accounts. So whether it's an IRA, whether it's a 401k or a retirement plan, or whether it's an inherited IRA, your own IRA, a retirement plan, or a inherited IRA, you're required at a certain age to take a distribution. The IRS tells us exactly how much we have to take. And if you don't take that, you face a penalty, which are significant. So at what age do you have to take a required minimum distribution? Well, for the longest time, it was 70 and a half. You might remember that. Well, it's not the case anymore. So starting with the Secure Act, that was moved to 72. And after the Secure 2.0, that was moved again to 73, and later it becomes age 75. So we're going to talk about those dates in a second. But once you reach these dates, let's say the new date of age 73, you have this RBD, or required beginning date. I'm just going to shorten those. So required beginning date. So the required beginning date is April 1 of the year following the year you turn 73. So if you turn 73 this year, you wouldn't have a distribution required until 4/1/2024, right? So this year being 2023, you wouldn't have, and you turned 73, you wouldn't have a RMD due until April 1st of 2024. That's your required beginning date. But most people take that distribution by the end of the year, because if you wait until 4/1/2024, you're going to have two in that year. So let's talk about these new rules and dates. So if you were born, I like the way, I think Dave McKnight broke this down first. I like the way he did this here. If you were born from 1950 or earlier, there are no changes. So you're either 70 and a half or 72, whichever. There are no changes for you. If you were born from 1951 to 1958, your RMD begins at age 73, or your trigger date actually is age 73. Your RMD may not begin until the following year, but that's your trigger date. 1959 or later, your RMD begins at age 75. So that's good. So these extensions are good from a planning point of view. It allows us more time to potentially do Roth conversions for people, transfer money from tax deferred, or as my mentor Ed Slott likes to say, forever taxed and never taxed. What I like to say is forever taxed and never taxed again. But it allows us more time to transfer that money over. So we have new dates, new rules, new dates. We have new rules, new penalties. The prior penalty was 50%. So up until about 8 weeks ago, under the Secure Act 2.2, or excuse me, 2, that's probably next, Secure Act 2.0, the penalty for missing an RMD was 50% of what you should have taken. So think about it. If you were required to take $30,000 out of your retirement accounts or IRAs and you missed it, your penalty would be $15,000. Well, they reduced these penalties to 25% or 10%. What's the difference? 25% is your penalty. It can be reduced to 10% if corrected within 2 years. So you might think, well, that's great. Well, it is great that the penalties are reduced. However, I think we're going to see more penalties. So how could that be? You might say, well, this 50% penalty was hardly ever applied. So there was a pretty simple process where if you missed your required minimum distribution, you would correct that issue, and then you would file a document with a form with the IRS and ask for forgiveness for various reasons. And I've never known anyone that didn't receive an approval to waive that penalty. Now I'm sure it happened out there, but I've never known anybody that didn't have that issue. So what do you think the IRS is going to say now that they've reduced this penalty? I think you're going to see a lot more 25s and a lot more 10s. They're going to say, okay, we'll reduce it since you took care of it, correct it within 2 years, because that's usually you realize it when you do your taxes the following year. So you're going to see a lot more 10% penalties. So that means a lot more money coming from taxpayers in the form of penalties, and of course to the IRS. The IRS is looking, Congress and the IRS are looking for all different ways to get more money out of the taxpayers. And this penalty was just the 50% penalty was just often not being applied because it's so big. So now this becomes a $3,000 penalty that you're definitely going to have to pay, in my opinion, as opposed to a $15,000 penalty that you're likely not going to have to pay. So how are these things calculated? Well, follow me over here. Where did I go? Hold on. There we go. Follow me down and over here. And we're going to look at this uniform lifetime table. Now, this form is downloadable on our website. It's wait till you see our new website. I swear we have a new website coming. I'm just pulling up my calculator. It's nearly done. I promise it's also nearly done. We're kind of in the last stages of it. So, I'm excited to share that with you folks, soon, hopefully by April, I think they said. So we only have, a few more weeks or we're past our time again. But, so this is how the calculation is done. This is the table as of 2022. So it's a relatively new table that we have. So just last year. So I don't think it's going to change anytime soon. But here's your age 73. If this is when you start required minimum distributions, let's just say that's when you start it. This over here is your life expectancy, 26.5. And for the first time, they actually have this percentage of account balance, because this column didn't used to exist. I don't need that. Let's close out of there. What's happening? We don't need, oh my goodness. We got a security alert. We'll fix that when we're done. All right. So in the past, we didn't have this column before, but they added it, and that's good. But this is how this is calculated. This is how your RMD is calculated. Let's say you have $1 million in your IRA. Well, let's say that was the year-end balance of your IRA as of 2022. You have to take the year-end balance, previous year-end balance of your IRAs, and divide it by 26.5. Right? So 1 million. However you want to show it. What was that? We'll just do that. Divide it by 26.5. Well, that gets you about $37,700. Or you can multiply it by 37.7, and you're going to get the same number. So that's your first year required minimum distribution. And if you don't take it, well, you're going to have a 25% or a 10% penalty, depending on when you correct it. Now we're going to talk about aggregation and if that $1 million is just in an IRA or a 401k, but that's how it's calculated. Now, what you'll notice here is that every year the number gets smaller and the percentages get more. So let's fast forward 10 years here. Now you're age 83. Well, your life expectancy factor now is just 17.7 years. Your percentage is 56.5 years. So if you use that same $1 million, let's carry this down here. Now you're 83 years old. And if your account hasn't grown at all, it's just maintained, let's say. Well, multiply that by the 5.65. That's pretty easy math. It's $56,500. And if you don't take it, then you pay a penalty, but you must take it. So what if you only need to draw $30,000 a year from your IRAs to meet your needs? Well, it doesn't matter. In the first year, they're going to make you take plus $7,700. And you might think, well, that's okay. That's just a little bit more. Well, here it's $26,500 more. That's more than two times of what you need. And they don't care. They don't care if you want it or need it. You still have to take it. And by they, I mean Congress and the IRS. So that is the required minimum distribution. And we're going to talk about how you can manage your required minimum distribution in a later webinar. But that is how the required minimum distribution is calculated. So that's the first rule you should know, is how that's calculated. Now let's come back up here. Follow me back up here. This is a big one, aggregation. So I just said to you, you had $1 million in your IRA. You use the calculation based on the prior year's the prior year-end value, and that was so. Let's stick with this example: 12/31/2022. So in this case, 3.77, and is that the right amount? Let me just double check myself. Yep, 3.77, so that's $37,700. Now, what if you also have a company plan, say a 401k with $1 million? And that is your 12/31 balance. You've got $1 million in your IRA and $1 million in your 401k. And that also requires a required minimum distribution. If you're not, I did it again, 37%. That's a lot. 3.77. That also requires a minimum distribution if you're not working, if you're not still working, so you're retired, and if you're not working, and if you are still working, if you're more than a 5% owner, then you have to take a required minimum distribution. But if you're not working, or if you are more than a 5% owner, then a required minimum distribution is due here. So that obviously is $37,700 also. So let's just assume you have an RMD due out of your 401k. You have an RMD due out of your IRA. Now, this is what I mean about aggregation. This is where people get in trouble. Some people might think, well, I'm going to take my combined $75,400, right? So that's $37,700 here, $37,700 there. I think my math is right, but somebody usually checks me and they'll let me know pretty quickly if it's not. But they might say, all right, you know what? I'm going to wait and take the money out of the 401k for whatever reason. They like the investments. You're doing well, whatever. And I'm going to take the entire $75,400 out of my IRA. Or it could be the other way. They might say, I like my IRA and it's doing really well. I'm going to take all that $75,400 out of my 401k. So that's aggregating. So they might do that for a couple of years. They might do it for 3 to 5 years. Well, what's the problem with that, folks? Well, the problem is you can't do it. You cannot aggregate retirement plans and IRAs. Can't do it. You can aggregate, I got to change my color here. You can aggregate IRAs. So if this $1 million is 5 different IRAs, so if this $1 million is made up of, let's make it easy. Well, that's pretty easy. 200,000 in one, 200,000 in another, 200,000 in a third, 200,000 in a fourth. I think you see where I'm going. 200,000 in a fifth, and that makes up your $1 million in IRAs. Well, you can do this. You can say, well, I had to take $37,700. I'm just going to take it out of IRA number 1. Or if it's IRA number 5, it doesn't matter. But you can take it out of a single IRA. You can aggregate your own IRAs. You can't do that. You cannot combine these two. If you said, all right, I've got this $1 million over here and 5 different IRAs that's in your 401k and 5 different IRAs, I'm going to take $75,400 out of IRA number 2 instead of $37,700. The IRS doesn't allow you to do that. All right, that's no good. So what have you done? And this people think they're being tricky and they're saying, okay, I'm figuring out how to do this. They're trying to do it on their own without professional help. And they go 3 or 5 years and they've missed the RMD out of this 401k. So it increases every year. So, that could easily be right over 5 years. Think about that. That could be hundreds of thousands of dollars that are due. Hundreds, let's say I didn't do the math, but let's just make it $250,000 of missed RMDs. That's possible, I guess. Let's just do a quick calculation together. That's it could easily be that. So let's just call it $250,000. Well, best case scenario, some of those years, right? Because if it goes 3 to 5 years, maybe when you discover somebody says, wait a minute, you can't aggregate IRAs and 401ks. Now, let me say this. You folks listen to me all the time and you read books and you attend classes and webinars and all that stuff. So maybe you're saying that's ridiculous. Who would do that? People do this stuff all the time. So it happens all the time. And these are the things that we get letters about through the Slott Group. And then they end up going to court and, their brother, plumber, cousin told them they could do this. And that's not the right way. So then you've got $250,000 of missed RMDs. Now, 2 of those years, you might get away with the 10% penalty, but you have 3 years, certainly probably going to get hit with a 25% penalty. So if it's $200,000 of that, let's just make some assumptions here. I'm going to do some quick math. Sorry. So that's $45,000 potentially for missing the first 3 years. And then what did I do there? I think I did 180. So then we have 70. So then another 7,000 for the last 2 years. This is just an example. That's $52,000 you owe in penalties for missing something. That is very confusing. Don't get me wrong. And it gets more confusing. So not only can't you aggregate IRAs and retirement plans, but the way you can aggregate IRAs together, individual IRAs, again, you can take one distribution to cover your combined RMD out of one IRA. You can take them all from different IRAs. That's okay. Retirement plans, you can't aggregate. I hope you get that. Number one, you can't aggregate retirement plans and IRAs. But you also can't aggregate retirement plans. So if you have, in the same example, if this $1 million is made up of 200,000 in 401k1, and then 200,000 in 401k2, because people have the retirement plans all over the place too, don't they? They not only sometimes have 5 different IRAs, and maybe 5 is high, but even if it's just 2, let's make this simpler. Let's make this easy, right? You got a $500,000 from a 401k you had 20 years ago, and $500,000 in a 401k that you just left last year, and now you're 73 years old, and you think that you know that you can't aggregate it with IRAs, but you say, hey, well, I owe $37,700. I'm just going to take it out of here because I know I'm really smart. I listen to these things. I read books, and I got this. I know I can't aggregate my IRAs and my 401ks, but I can. You might think, well, just like IRAs, I can aggregate these separately, right? You can't do that either, folks. These have to be taken separately. So half of the 37,700, which is 18,850. So you got to take 18,850 out of here, and you got to take 18,850 out of here. Now I know this is getting really kind of full, but that is important stuff. You can't aggregate retirement plans. You can't aggregate retirement plans with IRAs. Yes, you can aggregate your IRAs. And it's so confusing that we have a chart for it. And you'll be able to download this on our new website. It's not up on our existing one yet because this is new for this year, I believe. But retirement account RMD aggregation chart, and it is aggravating too, but we're talking about aggregation. So IRAs, including SEP IRAs and simple IRAs, so anything with that tag of IRA can be aggregated. Roth IRAs, well, it doesn't matter. There are no RMDs for Roth IRAs, and now no RMDs for Roth 401ks. So that's another good reason to consider converting to a Roth IRA or a Roth 401k. Company plans, excluding 403bs and IRA-based pension plans. You noticed I talked about 401ks and retirement plans, not 403bs, because there is an exception for 403bs. RMDs for each company plan, excluding 403bs and IRA-based plans. Anything with a IRA after it, this should be SEP IRA also, must be calculated separately for each plan and taken separately from each plan. If an individual is still working for a company sponsoring their plan or does not own more than 5% of the company, and 3, the plan contains a still working exception, an RMD may not be required for that plan until the year. That's a good point. I didn't mention that. If you're still working there and the plan contains a still working exception, then you don't have to take RMDs. 403b plans, I'm right here. RMDs for each 403b account must be calculated separately, but the total RMD for all 403b accounts may be taken from one or more of the 403b accounts, but you cannot do that with 401ks. If an individual is still working for the institution sponsoring the 403b plan and the plan contains a still working exception, an RMD may not be required for that plan until the individual retires. Okay, and then this is inherited IRAs. We're not even going to get into that, but as far as RMDs today, but read this because this is important too. RMDs for inherited IRAs of different decedents cannot be aggregated or combined in any way. RMDs for inherited accounts of the same decedent must be calculated separately, but the total RMD for all inherited IRA accounts of the same decedent, so the person who passed away, right? So if you inherited one from an IRA from dad and one from mom, you've got to treat them separately, calculate and distribute separately. If you inherited 2 from dad, then let's look at that. Inherited from of the same decedent must be calculated separately, but the total, so you got to calculate them separately, but the total RMD for all inherited accounts can be, I'm sorry, these are for Roth. Disregard. up top here. RMDs for inherited IRAs of the same decedent, that's where I want to be, must be calculated separately, but the total RMD for all inherited IRA accounts of the same decedent may be taken from one or more of the, I'm hovering over this, but you can't see it. One or more of the same decedent. I'm right here. My apologies. I was hovering over that with my pen, but you can't see it. And if you're just listening to this, you want to go to YouTube so you can see these charts I'm sharing with you. Okay. So I hope that gives you some clarity on aggregation, but I understand it's confusing. And I explained, so we talked about company plans, we talked about inherited IRAs, we talked about inherited company plans, and we also talked about IRAs. Then the potential issues we discussed. You could be aggregating something that can't be aggregated, or maybe not taking advantage of aggregating your IRA accounts. It might make sense to take it just from one account and calculate your entire RMD. We do that all the time for clients. So you might be missing an opportunity if you're not aggregating your IRAs, but you might be creating a big hassle if you're trying to aggregate your 401ks and certainly with your IRAs. All right, so we're going to talk next time about RMD tax-free withdrawals. And we're going to talk about QCDs and an amount below your standard deduction, but we're going to devote a webinar financial planning topic just to that on another day. So I know, like every week, this seems like a lot. There's a lot of scribble, a lot of references. Use these references, folks, on our website. These are the Slott Group's references. It's really wonderful that they produce this every year, and I give them all the credit. But I share them with you. You can download them. And they don't mind. Our job's to educate as many people as we can about these things. Okay, let me just switch away from my screen again. I'm looking for my cursor. There she is. All right. I hope that was all helpful today. Remember, we do have some things coming up. We've got our webinar next week. Remember, we don't do our webinars following a market holiday because I just can't get the information that I need, but I don't think we have a market holiday coming. We do have two questions. The first is from Doug. Hi, Doug. Doug asks, how do you sign up for the May 16th event? Well, Doug, you're going to be getting an invitation. So we'll make sure that as soon as that, we just finalized the invitation proof and the contracts and all that stuff for the theater and made sure we had everything we needed. So you'll be getting an invitation probably about 4 or 3 weeks before the event. But would love to see you again. Jerry. Hey, Jerry. Hello again. Pushing the RMD age to 73 may place some individuals into higher tax exposure after January 2026. You may want to display new 2023 tax table here. Thank you, Gerard. So the 2023 tax tables are something I use all the time, but we haven't, they're on our new website, but not the existing website. I usually keep them on the existing website until about the tax filing deadline, a week or two before. So we're just about there. But I've, in the past, when I've replaced them with updated tax forms too early in the year, people say, oh, I need last year's. So, good advice as always, Jerry. All right, folks, it's just about 11 o'clock. I hope that was helpful today. If you need to schedule an appointment with us or would like to schedule an appointment with us, you can reach out to us at admin@attleborowealth.com or questions@attleborowealth.com. Either one of those goes to the entire team. If you have questions, you can reach out to us at questions@attleborowealth.com. If you haven't already, please subscribe and hit the notification button and share the YouTube channel. If you love this or even somewhat like the information you get, share it with your friends. And we'd love to have more people join us. And, our goal here is to really get as many people out there as we can who are more educated, who understand this, who are more motivated to do what's best for their future retirement. But have a great week, folks, and we'll see you next week. Take care.